Let's cut through the noise and get straight to the facts. SoFi Technologies, ticker NASDAQ SoFi, is not just another fintech. It's a vertically integrated financial services powerhouse, a financial super app built to disrupt the old guard. The question isn't whether SoFi is a good company. The question is, at a market cap of over $28 billion, as of August 18, 2025, is it a good investment? To answer that, we have to go deep. We need to look at the numbers, the strategy, the risks, and the future. Live market snapshot. As of August 18, 2025, U.S. trading day. SoFi stock price, $24.13. Today's change, plus 1.5%. 52-week range, $6.75 to $25.11. Market capitalization, approximately $28.6 billion. P/E ratio, TTM, 48.91. EPS, TTM, 49 cents. The stock is riding a wave of momentum, up significantly over the past year. The recent surge, in particular, is directly tied to a phenomenal Q2 2025 earnings report. Let's break down what happened. The Q2 2025 earnings shockwave, the catalysts for the bull run. SoFi's Q2 earnings reported on July 29, 2025 were nothing short of a blowout. The numbers tell a compelling story of accelerating growth and a business model that is finally hitting its stride. Adjusted net revenue, a record $858 million, up a staggering 44% year over year. This wasn't just a beat, it was a demolition of analyst forecasts. Profitability. The company reported a net income of $97 million, a massive leap from the prior year. This marks a significant milestone, solidifying SoFi's position as a profitable entity. Membership and product growth. This is the core of the SoFi thesis, and the numbers here are electric. New members, 850. Zero net new members added in Q2, bringing the total to 11.7 million, a 34% increase. New products, 1.26 million new products were adopted, pushing the total to 17.1 million, also a 34% jump. CEO Anthony Noto's statement following the results was bold and captured the mood of the market. This is the worst we'll ever be. This kind of forward-looking confidence from leadership, backed by such strong performance, has clearly resonated with investors. Understanding the SoFi business model beyond student loans. Many still associate SoFi primarily with student loan refinancing. That is an outdated view. The company has successfully executed a multi-product strategy, diversifying its revenue streams across three core segments. Lending. This is the original engine of the business. It includes student loan refinancing, personal loans, and home loans. The company generates revenue from interest income on these loans, as well as from selling them in the secondary market through whole loan sales and securitizations. The recent $2 billion expansion of its loan platform business with Fortress is a strategic move to accelerate the shift towards a less capital-intensive, fee-based model. Financial services. This segment is the future. It's all about building the financial super app. This includes SoFi Checking and Savings, which offers a high-yield savings account and a debit card, SoFi Invest for self-directed and robo-advising, and SoFi Credit Card. The company makes money here through a variety of fees, including interchange fees on debit and credit card transactions, and management fees on its ETFs. This segment is crucial because it drives member engagement and cross-selling, creating a flywheel effect. The more products a member uses, the stickier they are, and the more valuable they become to the company. Technology platform, Galileo. This is the often overlooked crown jewel of SoFi. Galileo is a leading financial technology platform that powers other fintechs and financial institutions. Think of it as the picks and shovels of the digital banking gold rush. Galileo provides the back-end infrastructure for everything from digital checking accounts to credit cards. The revenue here is fee-based, generated from transactions and accounts managed on the platform. This is a high-margin, scalable business that provides a consistent and growing revenue stream, further diversifying SoFi's income and reducing its reliance on a single sector. Key questions every investor should ask. Can SoFi sustain this growth? The Q2 numbers were a major step, but sustaining this level of acceleration is the real test. The company is betting on its integrated platform to drive continued multi-product adoption. The ability to cross-sell from a high-yield savings account to a personal loan or an investment account is the key to their long-term value. What about competition? The fintech space is a battlefield. SoFi faces off against established giants like JP Morgan Chase and Bank of America in lending and banking, as well as agile digital competitors like Chime and Upstart. The company's unique advantage is its integrated platform. While others may specialize in one area, for example, lending or investing, SoFi aims to be the one-stop shop for all a person's financial needs. The challenge is to maintain a superior user experience and competitive rates across all products to prevent cherry-picking by consumers who only use them for the best single product offer. Is SoFi's lending business sustainable? A significant portion of SoFi's revenue still comes from lending. While their lending model is designed to be more resilient, they primarily target high-earning, high-credit score individuals. A significant economic downturn could still impact loan demand and default rates. The company's recent move to increase its focus on fee-based revenue is a good hedge against this risk. What about the macroeconomic environment? Interest rates, inflation, and the overall economic outlook are major factors. Higher interest rates can make it more expensive for SoFi to borrow money to fund its loans, potentially impacting its margins. However, a slowing economy could also increase demand for personal loans for debt consolidation, a key product for SoFi. It's a complex and dynamic landscape that requires constant monitoring, analyst sentiment, and price targets. As of mid-August 2025, analyst sentiment on SoFi is mixed but generally positive. The recent earnings beat has led to some upgrades, but there's a wide range of price targets, reflecting the company's still evolving business model and the inherent volatility of the fintech space. Average 12-month price target. The average price target is around $20.13, with a wide range from a low of $6.06 to a high of $31.50. This is a crucial point for investors. The average is a useful data point, but the spread highlights the uncertainty and the differing views on the company's long-term potential. Some analysts remain skeptical about its valuation, while others are incredibly bullish on its growth trajectory. Recent analyst actions. Since the Q2 report, we've seen a number of maintain ratings, with some analysts like Needham and Mizuho reaffirming their buy or outperform ratings. Conversely, others like Morgan Stanley and Keefe, Bruyette, and Woods have maintained their underweight or underperform ratings, a sign that not everyone is convinced by the recent surge. The bull case versus the bear case. The bull case, the super app, is working. The multi-product strategy is delivering, with record growth in members and products. This creates a powerful network effect and high customer lifetime value. Profitability is here to stay. The company has proven it can be profitable, a significant psychological and financial hurdle crossed. This is no longer a speculative growth at all costs play. Galileo is a secret weapon. The technology platform provides a high-margin, consistent revenue stream that is largely uncorrelated with the lending business. It positions SoFi as a key player in the wider fintech ecosystem. Strong leadership. CEO Anthony Noto is a seasoned executive with a clear vision and a track record of execution. His confidence is a significant asset. The bear case. High valuation. Despite the recent gains, the stock's valuation is steep. A P/E ratio near 50 suggests that a lot of future growth is already priced in. Any stumble in future earnings could lead to a sharp correction. Lending dependency. While diversifying, the company's revenue remains heavily reliant on its lending segment. A change in the credit cycle or a sustained economic downturn could hit the core business hard. Intense competition. The competition is fierce from every direction: traditional banks, neobanks, and specialized fintechs. SoFi needs to continue to out-innovate and out-execute a large field of well-funded competitors. Regulatory risk. The financial services industry is highly regulated. Any new regulations regarding data privacy, lending practices, or cryptocurrency could impact SoFi's business model and growth plans. Final takeaway for investors. SoFi is a classic, show-me stock that is now showing the market exactly what it can do. The Q2 2025 earnings report was a pivotal moment, validating the company's long-term strategy and proving its ability to generate significant growth and profitability. The stock's journey from a sub-$10 price to its current levels is a testament to that progress. However, the investment is not without risk. The valuation is high, and the company operates in a hyper-competitive and economically sensitive industry. Investors must weigh the potential for continued explosive growth against the inherent risks of a still young company in a rapidly evolving sector. This is a stock for long-term investors who believe in the vision of a one-stop-shop financial super app. It's not a quick-flip trade. The key metric to watch in the coming quarters is not just revenue growth, but the continued expansion of the member base and, most importantly, the average number of products per member. That will be the true indicator of whether SoFi is successfully building a moat around its business. The story is far from over, and for those with a high risk tolerance and a long-term horizon, SoFi remains a compelling though volatile